Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to your U.S. Market Update. I'm Emaad Akhtar. The S&P 500 had a good one on Thursday, closing at a fresh record high after an afternoon boost pushed stocks solidly into the green as traders shook off weak private employment data earlier in the day. The broad market S&P finishing up 0.8% to close at 6,502, while the Nasdaq Composite settled up 0.98% at 21,707. The Dow Jones Industrial Average, meanwhile, finished up as well, 350 points, 0.8% or just under at 45,621. This was the S&P 500's 21st record close so far this year. Equities marched higher as investors reasoned that the recent ADP data was weak enough for the Fed to justify a September rate cut, but not soft enough to herald a recession. Let's get into what's happening then stateside with Mark Newton, Managing Director and Global Head of Technical Strategy at Fundstrat Global Advisors. Mark, welcome back to the show. How are you doing?
Thank you very much. I appreciate having me back.
Yeah, thanks for coming back on. Now, as I said, the S&P 500's 21st record close so far this year. Who is leading the charge? Why such great numbers?
Well, look, I think for a long time it was technology for the first few months off the April lows. Since then, we have seen a little bit of a broadening out in the rally. Technology, honestly, has underperformed in the last month, while other groups such as consumer discretionary and materials and financials have shown better strength. We've also seen a pretty remarkable comeback in small and mid caps, which had been lacking for some time. So I think that is bullish for, the intermediate picture of equities between now and year end. I have a little bit of concern in the near term, just given some of the seasonality and cycles which do show an above average possibility of some short-term weakness, but I don't sense that should prove long-lasting. I think we are going to just have a brief sell-off that might start in the next week or two that takes the S&P down to about 6,300 from, 6,500 or so. And, thereafter, I sense that we can make some progress up into the month of October.
Yeah, August and September, traditionally or historically weak months for markets. That being said, August proved to be quite bullish. What are you expecting for the rest of this month?
Well, honestly, there's a couple issues that maybe investors aren't paying close attention to, and one is that we have seen a little bit of breadth erosion in the past couple weeks, and so, extreme weakness out of software stocks has hurt technology. Things I look at, such as McClellan's Summation Index, have been moving lower since July, and, honestly, there hasn't really been a ton of optimism, though. That's one thing that is still in the bulls' favor, is that people largely are still pretty offsides, concerned about tariffs, concerned about inflation. I don't think those are going to be issues that really cause market volatility as much as people expect. I mean, wage growth has been going down. If anything, it's tough to see inflation when you don't have wage growth. And, the data in recent weeks, we've seen ISM and also, the growth stat seems to suggest the labor market has been also slowing down pretty sharply. So, firms clearly are not hiring, but they're also not laying off. So we're in an interesting dynamic, but you are starting to see the long end of the curve start to break down pretty sharply. Today we saw in the U.S. 10-year Treasury yields close down at the lowest levels we've seen in multiple months. We broke 418 on the 10-year, which is technically significant. And that means that if we were to get, a weak payrolls number tomorrow, we could really see yields start to pull back very sharply.
Yeah, as you rightly pointed out, looks like there's trouble in the labor market. Private sector hiring numbers came out below consensus forecast of 75,000. They came in at 54,000 according to ADP. They've cited rising worries from consumers, labor shortages, disruptions tied to AI as potential drivers of this decrease in growth. Concerning picture in the labor market may strengthen an already solid case for rate cuts come the Fed's meeting later this month. CME's FedWatch tool is predicting a 97.4% chance of a rate cut at the gathering. That's up from, I think, just under 97 a day ago. Is that pretty much in line with what you expect?
I do. I always pay attention to what the Fed fund futures, and the swaps curve shows us. I think that the Fed rarely goes against that if it's fully priced in, like what it shows now. So, yeah, it looks like we have two rate cuts that are going to happen between now and the end of the year, and probably an additional 2 between the beginning of the year and next summer. So we have about 4 rate cuts. Meanwhile, we have a very dovish Fed at this point. We have a very solid earnings season that's just passed, and the economy, despite a little bit of weakness on the fringe, is still largely holding up okay, and so that's actually a Goldilocks type period where investors are not all that complacent and speculative. If anything, they're worried, but generally trends have been fine in equities, and a lot of that has been, of course, the Magnificent Seven, which has helped to drive a lot of this rally, but it's gotten a little more broad-based, and I think that gives me some reason for some comfort, I think, between now and end of year.
Yeah, I think another thing that will give investors reason for comfort is the recent performance of gold. Now, bullion has recently surpassed the $3,550 per ounce threshold, breaking records and taking even the most optimistic forecasters, Mark, by surprise. There are some that predict the metal could increase by another 20%, possibly pushing it above 4,250 per ounce in the upcoming months. Is that a bit too optimistic, you think?
Well, in the short run, my own target is right around 3,800. Gold was in about a 4.5-month consolidation period, and so the breakout that happened earlier this week was something that many people saw very clearly. Silver has actually had better performance than gold since April, and I think that's also worth pointing out as being an industrial metal. As China has come back, we've seen silver really start to outperform sharply, and of course China being the largest importer of silver ores in the world. Certainly interesting. But there's ongoing fiscal concerns. That's a problem. We have a number of cuts being priced in now, and so that's certainly very favorable for the metal. My only real concern for gold is that it is starting to get overbought on a number of different metrics. And so, it's had a decent 3-year run. Honestly, we've had a great move in gold. This isn't now the time to start to put all your money into gold, but I do sense it can work a little bit longer. So some of the cycles that I look at suggest an October peak, and then we pull back a little bit. And so, we'll see if that plays out. It should be interesting. But as rates are falling, that should generally be supportive of precious metals and industrial metals, pushing higher.
So in summary, Mark, against the backdrop of what we're seeing in the current market environment, how should investors strategically be positioning themselves?
Well, I think a little bit more of a diversified positioning makes sense than maybe what was the case 6 months ago. I don't love being 100% in technology for those that don't have longer-term time frames. I think emerging markets make a lot of sense given that the dollar remains in a downward trend and likely should continue lower over the next few months. And so I think that emerging markets mixed with precious metals, mixed with, some exposure and maybe things other than technology, such as, utilities, consumer discretionary financials make sense. I think if you're going to be in tech, I think you have to favor the tech hardware. So stocks like Dell and Apple, HP, Seagate, some of the disk drive makers have been really the driving forces behind technology, which arguably has still been pretty flat, over the last month. But one wants to really avoid some of the software names for the time being, which seem to be a little bit behind the curve with regards to AI, and there's still a lot of question marks there. So tech is a little bit of a splintered sector and has shown some bifurcation and probably needs a little bit more selectivity. But, the market's still in good shape. I think we probably can't avoid an eventual pullback, which probably happens between now and November over the next 2 months. So I think we have to be prepared for that. But at the same time, longer-term trends are still in good shape.
All right. A diversified portfolio is the word on the street. And we've been in conversation with Mark Newton, Managing Director and Global Head of Technical Strategy at Fundstrat Global Advisors. Mark, as always, it's been a pleasure having you on the show.
Thank you. Likewise.
All right. Take care. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.